The Psychology of Money, by Morgan Housel, is a book that explores the complex relationship between humans and money. In this 10-minute video, we'll summarize the key takeaways from each chapter of the book, and provide real-life examples and anecdotes to help illustrate the concepts. The book writer, Morgan Housel. Morgan Housel is a renowned author and financial expert who has spent years studying the psychology of money. His book provides valuable insights into how people think about and manage their finances. Chapter 1, No One's Crazy. The first chapter of the book discusses the fact that everyone has their own unique approach to money. Housel argues that there is no one-size-fits-all solution when it comes to managing finances. He encourages readers to acknowledge their own biases and to recognize that others may have different priorities and goals. To illustrate this point, Housel tells the story of a man who bought a house in the early 2000s and was criticized by his friends for not investing in the stock market. The man stuck to his decision and ended up making a substantial profit when the housing market boomed. The lesson here is that everyone has their own unique perspective on money, and what works for one person may not work for another. Chapter 2, Luck and Risk. The second chapter of the book explores the role of luck and risk in financial success. Housel emphasizes that while luck plays a significant role in financial outcomes, risk can be managed and mitigated through thoughtful planning and diversification. To illustrate this point, Housel tells the story of a professional gambler who amassed a fortune through his skill at poker. However, the gambler eventually lost it all when he failed to diversify his investments and took on too much risk. The lesson here is that while luck can play a role in financial success, it's important to mitigate risk and invest in a diversified portfolio to avoid losing everything. Chapter 3, Never Enough. In Chapter 3, Housel discusses the phenomenon of never enough, and how it can lead to unhealthy financial habits. He encourages readers to recognize the importance of contentment and to focus on building a sustainable financial plan that prioritizes long-term goals over short-term gratification. To illustrate this point, Housel tells the story of a man who constantly pursued more wealth and success, even when he was already financially secure. The man ended up losing his family and friends, and realized too late that he had sacrificed too much for money. The lesson here is that it's important to recognize when enough is enough, and prioritize long-term goals over short-term gratification. Chapter 4, Confounding Compounding. The fourth chapter of the book delves into the power of compounding interest and how it can be used to build wealth over time. Housel emphasizes the importance of starting early and consistently investing over a long period of time. To illustrate this point, Housel tells the story of two hypothetical investors who both start investing at age 25, but one invests consistently over time while the other waits until age 40 to start investing. The investor who started early ends up with a significantly larger portfolio due to the power of compounding interest. The lesson here is that it's important to start investing early and consistently to take advantage of the power of compounding interest. Chapter 5, Getting Wealthy versus Staying Wealthy. Chapter 5 of the book explores the difference between getting wealthy and staying wealthy. Housel argues that while getting wealthy often involves taking risks and pursuing high returns, staying wealthy requires a different mindset focused on preserving capital and minimizing losses. To illustrate this point, Housel tells the story of a man who made a fortune in the stock market but lost it all when he failed to properly manage his risk. The man had focused solely on pursuing high returns and had not considered the potential downside risks. The lesson here is that staying wealthy requires a different mindset than getting wealthy, one focused on preserving capital and minimizing losses. Chapter 6, Tails, You Win. In Chapter 6, Housel explores the concept of asymmetric risk, or situations where the potential upside greatly outweighs the potential downside. He argues that seeking out these opportunities can be a profitable strategy, but it requires a willingness to take on risk and accept the possibility of losses. To illustrate this point, Housel tells the story of a man who invested in a startup that had the potential to become a billion-dollar company. While the investment carried a high level of risk, the potential upside was so great that it made sense to take the risk. The lesson here is that seeking out asymmetric risk opportunities can be a profitable strategy, but it requires a willingness to take on risk and accept the possibility of losses. Chapter 7, Freedom. Chapter 7 of the book explores the concept of financial freedom and how it can be achieved through thoughtful planning and wise decision-making. Housel argues that financial freedom is not just about having enough money, but also about having the ability to make choices that align with one's values and goals. To illustrate this point, Housel tells the story of a couple who achieved financial freedom by prioritizing their long-term goals and making smart financial decisions. The couple was able to retire early and pursue their passions, demonstrating that financial freedom is achievable with the right mindset and planning. The lesson here is that financial freedom is not just about having enough money, but also about making smart decisions and aligning one's values with their financial goals. Chapter 8, Man in the Car Paradox. The 8th chapter of the book explores the concept of happiness and how it relates to money. Housel argues that while money can provide a certain level of happiness, it's important to recognize that true happiness comes from within and cannot be bought with wealth. To illustrate this point, Housel tells the story of a man who had achieved great financial success but still felt unfulfilled. The man realized that true happiness came from spending time with his family and pursuing his passions, rather than accumulating more wealth. The lesson here is that while money can provide a certain level of happiness, true fulfillment comes from within and cannot be bought with wealth. Chapter 9, Save Money. Chapter 9 of the book focuses on the importance of saving money and how it can lead to long-term financial success. Housel argues that saving money is not just about accumulating wealth, but also about developing healthy financial habits and a mindset focused on long-term goals. To illustrate this point, Housel tells the story of a man who saved consistently throughout his life and was able to retire comfortably. The man had developed healthy financial habits and had prioritized his long-term goals over short-term gratification. The lesson here is that saving money is not just about accumulating wealth, but also about developing healthy financial habits and a mindset focused on long-term goals. Chapter 10, Reasonable, Rational. The final chapter of the book explores the concept of reasonableness and how it can lead to better financial decision-making. Housel argues that while rationality is often touted as the ideal mindset for making financial decisions, it can be limiting and even harmful in certain situations. Instead, he advocates for a mindset of reasonableness, which takes into account the complexity and unpredictability of the world. To illustrate this point, Housel tells the story of a hedge fund manager who made a series of rational, but ultimately disastrous, financial decisions. The manager had focused solely on data and statistics, without considering the broader context and risks. The lesson here is that a mindset of reasonableness, which takes into account the complexities and uncertainties of the world, can lead to better financial decision-making. Conclusion. The Psychology of Money provides a unique and insightful perspective on the intersection of psychology and finance. By exploring the stories and experiences of real people, Morgan Housel demonstrates how our emotions, biases, and mindsets can impact our financial decisions. Whether you're a seasoned investor or just starting out, this book provides valuable lessons and insights that can help you achieve long-term financial success. From the importance of saving and investing wisely to the need for a mindset of reasonableness, The Psychology of Money offers practical and actionable advice for anyone looking to build a more secure financial future. So, if you're looking for a thoughtful and engaging exploration of the psychology of money, be sure to check out Morgan Housel's The Psychology of Money.